Welcome to InvestInfluence. In this video, we will discuss what happened to the First Republic Bank. First Republic Bank led a decline in bank shares Monday that came even after regulators' extraordinary actions Sunday evening to backstop all depositors in failed Silicon Valley Bank and Signature Bank and offer additional funding to other troubled institutions. San Francisco's First Republic shares lost 61.8% on Monday after declining 33% last week. PacWest Bancorp dropped 45%, and Western Alliance Bancorp lost more than 47% as regional bank stocks fell sharply. Zions Bancorporation shed about 26%, while KeyCorp fell 27%. Other financial firms were also under pressure, as Bank of America slipped 5.8%, while Charles Schwab tumbled more than 11%. The declines came despite Sunday's news that the Federal Reserve created a new bank term funding program that will offer loans for up to a year to banks in return for high-quality collateral like treasuries. The central bank also eased conditions at its discount window. First Republic said Sunday it had received additional liquidity from the Federal Reserve and J.P. Morgan Chase. The bank said the move raises its unused liquidity to $70 billion, before any funding it could get from the new Fed facility. First Republic's capital and liquidity positions are very strong, and its capital remains well above the regulatory threshold for well-capitalized banks, said founder Jim Herbert and CEO Mike Roffler in a statement. Herbert also told CNBC's Jim Cramer on Monday that the bank was operating as usual and was not seeing that many depositors leave. Western Alliance said in a statement that it is seeing moderate outflows and that it had taken additional steps to strengthen its liquidity. Meanwhile, the S&P Regional Banking ETF lost 12% on Monday following a 16% decline last week. The slide for regional bank stocks on Monday comes after a rush of withdrawals from SVB Financial forced that bank to close. A key issue was SVB's high percentage of uninsured deposits, as the majority of the bank's customers were not guaranteed to get their money back before the regulatory moves over the weekend. While SVB had an unusually high percentage of uninsured deposits, there are other mid-sized banks that could be at risk of large withdrawals. We believe regionals with less diversified and large uninsured deposit bases are at risk of deposit flight but not at the speed of SVB, and they should have time to tap wholesale funding markets, such as FHLB, and raise cash levels. In a fragile environment like we are in, we believe banks should be cautious about the potential negative signaling effect of raising deposit rates to keep deposits, Citi analyst Keith Horowitz said in a note to clients. SVB was the largest U.S. bank failure since 2008, with $212 billion in assets. First Republic reported roughly $213 billion in assets as of December 31, according to a securities filing. While First Republic is not as concentrated in one industry as SVB was with technology, the bank does tend to cater to businesses and wealthy individuals who have large uninsured deposits. Unfortunately, one of the first consequences of SIVB's collapse is probably that it will cause a flight of uninsured deposits from smaller, less diverse banks to larger, more diverse ones, Oppenheimer analyst Chris Katofsky said in a note to clients. Correction. The S&P Regional Banking ETF fell 16% last week. An earlier version misstated the percentage. So what is the exact reason behind this correction or dump in the bank's share? Let's find out. Shares of U.S. regional banks slumped on Monday, led by sharp losses in First Republic Bank, FRCN, as news of fresh financing failed to assuage fears of possible bank contagion following the collapse of SVB Financial Group, SIVBO, and Signature Bank, SBNYO. San Francisco-based First Republic has been able to meet withdrawal demands with the help of additional funding from J.P. Morgan Chase & Co., JPMN, the mid-cap lender's executive chair, Jim Herbert, told CNBC. His reassurance did little to keep the stock afloat. There were multiple trading halts as shares tumbled, last down 67% at $28.05. There were multiple trading halts on bank shares as the KBW Regional Banking Index, KRX, fell 5.4%, and the S&P 500 Banking Index, SPXBK, dropped 6%. The real issue for the industry is that there is a crisis of confidence in the stickiness of deposits, and when that becomes dislocated, things can move very quickly, said Christopher McGrady, head of U.S. bank research at investment bank KBW. U.S. President Joe Biden vowed to do whatever was needed to address a potential banking crisis. On Sunday, national regulators took emergency measures, and First Republic secured additional financing through J.P. Morgan and the U.S. Federal Reserve, gaining access to a total of $70 billion in funds. Despite the cash infusion, Raymond James double downgraded the bank stock, highlighting the risk of deposit outflows from panicked large depositors after the bank run at SVB. Founded in 1985, First Republic had $212 billion in assets and $176.4 billion in deposits as of the end of last year, according to its annual report. About 70% of its deposits are uninsured, above the median of 55% for medium-sized banks and the third highest in the group after Silicon Valley Bank and Signature Bank, according to a Bank of America note. Bank of America slashed its price target on the stock to $90 from $140. The banking rout, which follows several Fed interest rate hikes over the past year, has pushed down yields on the 2-year Treasury note by the most since the financial crisis of 2008. Art Hogan, chief market strategist at B. Riley Wealth, said the market is finding out in real time what the risk of rising interest rates at such a fast pace can do to the balance sheets of some of the regional banks. Hogan said each regional bank has its own exposure to different parts of the market. He added the fate of regional bank stocks will be case by case, as investors look to see which ones could have the most negative exposure. Brian Levitt, global strategist at Invesco, said the market is focusing on smaller banks with specialty lending businesses. After Silicon Valley Bank, investors turn their attention to the next bank exposed to interest rate and specific credit risks. First Republic Bank, which has significant exposure to the coastal real estate markets, appears to be next on the list. Among Wall Street lenders, Bank of America Corp. (BACN) dropped 3.3%, Citigroup Inc. (CN) and Wells Fargo (WFCN) slid about 6% each, while lenders in Asia and Europe plunged too. The U.S. System of Federal Home Loan Banks (FHLB), which lends to banks and other member financial institutions primarily to help them make mortgages to consumers, is seeking to raise about $64 billion by selling short-term notes, Bloomberg News reported. Source of the news: CNBC News and Bloomberg News. Thanks for watching. We will see you in next video. Don't forget to like, share and subscribe to InvestInfluence for daily financial, stock, and crypto market news.